Now we're moving on to term number 13, the general ledger. This is the place where the company's accounts are summarized. This ledger is kind of like the big kahuna. I mean, this is the big deal when it comes to your overall bookkeeping system. Why is the general ledger so important?
Well, the general ledger is used as a summary place for all the transactions that are encountered and entered into by the organization. And so you have to have a general ledger just to have a place in your accounting records to summarize all your activities by category, such as direct labor, insurance expense, both assets, liabilities, income, and expense. And the general ledger, the pitfall I see there with entrepreneurs is they don't design their general ledger correctly to begin with.
Oh.
Initially, you should develop a coding scenario. It's referred to as a chart of accounts.
Okay.
And then for each item in your chart of accounts, you then have a general ledger account. And so with the software that's available to do bookkeeping and accounting with currently, once you design the proper chart of accounts, that pretty much assures you have the correct general ledger. So the problem I typically see is that we don't design the chart of accounts properly.
Ooh.
We don't put in certain expenses, or we put them in a broad sense, like what is a good example? Insurance expense.
Okay.
We have one category called insurance expense, and we're charging medical, liability, workers' comp, disability, fire and casualty, all of this going into one category. And you might say, well, it is all insurance, and I agree. And IRS will accept that. They don't care that you put all your insurance in one category. But
yeah.
My recommendation is that you would split those out into the types so that when you engage in this comparing of expenses for this 6 months this year to this 6 months last year, you can see that this expense is way up, this one's down. In other words, it gives you better ability to manage expenses.
And kind of adding a little entrepreneurial spin to this for a second. If you're watching this, and let's say that you spend $1,000 a month on advertising, as a big broad brush, advertising.
Right.
That might not be helpful for you to know that. That might not be helpful at all for you to know that. But if you know that you spend $900 on your internet advertising, and you spend $100 on your mailers, and your internet advertising produces you zero business, and you get all your business off of your mailers,
exactly.
Then you can know, hey, next year I need to reallocate, I need to move money from here and focus it here. Same thing with accounting. I mean, in accounting, the more specific it is, the more it gives you mastery over, wow, I'm spending a lot more money than I thought I should in this specific area. But when you group things into big, broad blocks, it becomes impossible to sort them out, right?
That's correct. And that's another area where a good advisor or a good accountant can help the entrepreneur when they're starting out, or even after they're already in business. Maybe they need to expand and improve upon their chart of account. Their accountant should be able to help them along those lines.
Now we're getting to term 14. Here we go. Talking about interest. Interest. This is defined as the money that a company needs to pay for the use of money it borrows from a bank or other company. Where do companies usually get it wrong as it relates to interest? And what does interest mean?
Well, interest, of course, is the cost of using somebody else's money.
Okay.
Some people have referred to it as renting money.
Renting money, okay.
And so interest is not a bad thing if it's used correctly. Some of the mistakes I see regarding interest is that entrepreneurs don't split out their principal and interest. So they make a payment to the bank and they charge the entire payment against the note payable on the balance sheet, and they don't show any interest expense in their profit and loss. I see that quite often.
Okay.
The other risk of interest is that you have to look at interest from the standpoint of what does that do to your profitability? Can you with the incurring of this interest, does it still allow you to make profits on your job, or is it going to render you to where even though you can do more work, maybe the cost of the interest is so great.
I see this in small business more than anything. When someone's starting up a business, and let's say they need to borrow $50,000, so they'll put it on an American Express card and they'll charge it up there. Well, now they're paying 15% interest every month just to use the money. They're not even paying the principal down at all. And so they just spent $50,000 on the card, but their interest payments are substantial. They might be $6,000 or $7,000 a month in just interest. And so it becomes very hard to make a profit there. So you just got to be mindful of that, right?
Very careful.
And a good accountant can help you find out if you're wasting money on interest, maybe consolidate a few loans into one place. There's a lot of things you can do there.